As we can see with the VIX here on the daily, we came up to that exact area, which was obviously the double heart line, the heart line of the channel, the heart line of the descending channel. And then obviously we have our 200 exponential and simple clearly in a downtrend. And once again, we got rejected at those levels as expected, which is basically going to tie in inversely to the stock market getting bought up essentially. So if we go over to, let's skip oil and we'll come back to it. Let's skip oil for a second. If we just look at the Dow Jones now on the daily, we will see obviously same thing happen again. We had that pretty violent sell-off. We got bought back up almost all the way. Another pretty violent sell-off to slightly lower low. Got bought up almost back to the way. The most important thing I'm paying attention to is we are now below that resistance that we flip support, this green line right here. So to me, that's a breaking point. And then obviously also we had this ascending blue trend line as well that we have been respecting pretty heavily. It started back on February 21st, essentially this point here. And then, we touched it again on March. And then each time we've come down to it, we've gotten less of a bounce these times. And then now we have broken through it. It's not unrealistic when we break through an ascending support line like this to push all the way back up, put in a new high, and then get rejected at that trend line. So I would not be surprised in the slightest bit if we basically saw something that amounted to price pushing back up here and then getting rejected at that point and then getting, basically like an actual sell-off like that. It doesn't have to happen, but it happens very often in markets and is unexpected because as soon as we put in a new high, everyone gets bullish again. But what did they do? They basically just bought the breakout and then get stuck upside down in the position from, record highest prices ever. Or essentially somebody has a stop loss and they put the stop loss slightly above that point. So maybe they're not even intentionally buying, but the moment that it goes to a new high, their stop loss position gets taken out and then they've essentially just bought because they had to close their short position at all-time highs. So it might not be like they're consciously like, oh, I'm buying the breakout. Sometimes you are literally just short and then your position is to buy the breakout and close your short position. Or flip long, essentially, whatever. But again, we're paying attention to this key area right here. Seems very important to me, obviously. And we broke down from a key ascending support line, which is less weighted, as where, a horizontal is much more weighted because it's not nearly as subjective. So when we break through this, we come up and get rejected essentially at it after basically what amounts to a week of selling and break of key zones. The 8 and 21 on the daily have crossed to the downside. We got the hard sell signal. We obviously had left the bullish control zone. We're below the zero line. We now have a red slope line on the TJD, TDMACD, and all red histograms. So at this point in time, I don't think we're just going to get some capitulation event that comes in, but I do think we will see continued selling throughout the week. How this week closes on Friday is going to determine probably the overall confidence of the market. But what I'm expected right now is probably the push down here to the green box area at like 33.6, roughly 33.550, somewhere around there, which is going to line up also with the top of our ascending, or well, really it's just a megaphone broadening wedge. So I think that is most likely our target. And then obviously if we take away the drawing tools, it's very clear that that is just a retest of the 200 exponential and simple. So, depending on when we come down to them, it could be slightly higher. If we just came down to it tomorrow, it would hit right on our box right here and also the previous low right here. So I think that's probably our target, somewhere around like 33.250 to like 33, let's say 500. But essentially what we're looking for now is we're seeing weakness that we don't normally see with continuation. Now it is possible obviously that we get continuation to the upside, but once the 200 exponential is on top of the 200 simple, that's going to be more reactive to price. So if the trend is still gaining strength to the upside or even just maintaining current strength to the upside, we should be seeing the 200 exponential stay on top of the 200 simple. But we'll see here now for the first time since the lows at the CVD dump, since we got that cross back here on September of 2020, we'll see now that the 200 exponential has crossed above, 200 simple has crossed above the 200 exponential, telling us that the trend is weakening. Each other time when we got the 821 cross and we broke down and found support, the 200 exponential was above the 200 simple. So the trend was still strengthening. So what we need to look out for now is there an actual change in trend taking place right now? Does that mean we have to just sell off and go to zero tomorrow? No, not at all. But what it means is every other time throughout this trend, we were in a powerful uptrend and it was gaining or at least maintaining strength to the upside. Now we have, basically more and more of our little warning signs, our little lights flashing, telling us that this trend is potentially slowing or coming to an end. So that's what we're paying attention to. Most people don't lose their money in a bull run. Most people don't lose their money in a bear market. Most people lose their money in the switch between a bull market and a bear market. You either, buy at the top and then price starts going down and you keep buying the dip, but the dip takes a dip and the dip takes a dip. And the next thing you know, you don't have any more fuel. And, in a situation like this where the economy is potentially waning or weak or being artificially propped up, which it clearly is, and then you're investing in stocks. Well, if all of a sudden we go into like another recession or depression, it's possible your income flow could be affected. Therefore, you might not have that dry powder to buy the dip. So that's why it's so important. And then, also the opposite. People get used to shorting throughout a long bear market, and then all of a sudden it flips over to a bull market and they can't recognize that the trend has changed now. So that's why it's so important to have a clearly definable way to determine trend. So for me, that's why I use the TJD, TDMACD. I do use that, obviously, the Jewel Thief as well, but that's why I created the brand new indicator, the Master. And it's the moving average strategy that I use to determine a bull market or a bear market. So now here we are on the weekly, and as long as we're above the 200 exponential and 200 simple, and they are sloped to the upside, they're blue like this, we're in a bull market. We're in an uptrend. So on the weekly, we are still 100% in a bull market on the Dow Jones Industrial. And we will notice, the last time we went into a bear market on this indicator based on my strategy, the way I determine it, was in 2008. So what was 2008? Well, this was the mortgage crisis. So once we had broken down from the 200 exponential and simple, we came back up, retested them, and once price action was below the 200 exponential and simple for long enough, they flipped over, the slope became negative, and then this indicator turns, purple for the 200 simple and red for the 200 exponential, telling me clearly at just a glance, we're now in a downtrend. I no longer want to be buying dips. I want to be selling rips. So the difference being, every time we take a dip in a bull market, you want to buy because you're expecting price action to go up. Then you buy the dip, then it goes up, then you buy the dip, then it goes up, then you buy the dip, and then you start to notice based on the 821 here, once we get the cross on the 821, you say, hang on, there might be something taking place. Something doesn't seem right, but I'm still going to buy the 200 exponential and simple because we're still technically in a bull market, but I'm seeing a lot of confluence that potentially the trend is changing. And that's what the 821 is doing. It's telling us the trend is potentially changing, but on a longer time frame, moving average, we're still bullish. And then eventually we bounce the 200 exponential and simple. We put in a lower high, telling us once again, things are changing. We're now putting in a high and then lower high. The trend is starting to look more bearish. And then of course the breakdown to the 200 exponential and simple, last ditch effort. We attempt to push back up one more time. The slope flips over to red on this or purple, depending on which one you're looking at which point in time you have officially entered a bear market. So how much time did that save you? How much price action did that save you? What is the purpose of this strategy and why does it work so well? Well, if we look at time and we look at percentages, it was a 44.8% decline, so roughly a 45% decline, and 203 days. So if we can have a strategy that saves us 203 days worth of pain and buying dips that continue to dip, and then also 45% of our portfolio by exiting positions or at least not buying any further positions, that's going to put us at an extreme advantage over somebody that just holds through that downtrend and just suffers. And that's assuming that you just have diamond hands and you can just hold and you never sell. And then eventually, obviously, what happens? Well, we're in an 821 cross to the downside this entire time. And then here we see, based on my strategy, the way I determine these markets and the trend, we see now a potential change in trend starting to take place. So the same way the 821 cross to the downside was here, but we still had a positive trend on the 200s. This was our warning sign. This was our confirmation that we're in a bear market. This here is our warning sign that the bear market is ending, or, warning sounds bad. Obviously, maybe it's like, a ray of sunshine, some hope in the markets. And then obviously at that point in time, you can start laddering back into positions, but you're really not overall completely bullish on the market again until actually way further down the line. So at that point in time, we're looking to enter positions here, but still cautious, the same way that we're looking to, exit positions here, but still cautious. that we may decline further. Once we finally get on top of the 200 exponential and simple, we bounce the 200 exponential and simple, one more retest by the bears to try to push price action back down. Or maybe that's not even some manipulation and the bears and the bulls are really the same people, but it's just algorithms trying to determine if now the market is strong and wants to continue to the upside. So at that point in time, we bounce the 200 simple perfectly. It still has a negative slope, so we're still cautious, but the 200 exponential has had a slope to the upside that entire time. Well, let's talk about two things here. So obviously, once we're on top of price action, the 200 exponential is sloped to the upside. The 200 simple is sloped to the upside. They're now both blue. We have the 821 cross to the upside. They're both green. That is full on, risk on, absolute bullishness in these markets long term on a weekly time frame based on my personal strategy. Now, what we're paying attention to, though, obviously we can look at the other indicators and oscillators and get an idea of moves and when we're gaining strength and losing strength, all that stuff. But something key happens here. It doesn't happen at the top because we lose strength so fast. The 200 exponential is above the 200 simple the whole time. So we had the bright blue above the dark blue the whole time, and then actually they cross right here at the same time that we basically flip into a bear market. But once the 200 exponential right here crosses back above the 200 simple here, even though it's slightly before the 200 simple flips over blue and we get like the confirmation, it tells us here that we're now not only going to the upside, but we're gaining strength to the upside. So that's the, obviously the opposite of what we were talking about earlier, where we had a situation like this that's currently taking place on the daily, where we've been in a long bull trend to the upside. And then here we have basically the 200 simple, the lighter blue, well, depending on how you look at it, the more shady looking blue, not the bright blue. Once the shady looking 200 simple blue, the slower to react, crosses above the 200 exponential, it tells us this trend is weakening. So that's a sign of weakness. Hang on, something's not right here. We're losing strength in this trend, and now the 200 simple is on top. And then we break down from that, come back up, retest it. But you'll see here the 200 exponential and simple both still have a slope to the upside. So technically we're still bullish in these markets, but we've gotten a warning sign here. We've started to get warning signs from the 821s crossing to the downside. And then here finally, this is our last attempt. This is currently what is happening with Bitcoin right now that we're paying attention to. We have broken back above. The 200 simple went above the 200 exponential after we peaked out. We then put in a lower high here. We broke down, came back up. We're on top of the 200 simple and 200 exponential, trying to cross these back to the upside, trying to maintain price action on top of these two long enough that we can go back into a continued bull trend. But what, so basically we're in like the risk off or the danger zone. But, we have this easy spot now to manage risk off of, because basically if we stay above the 200 exponential and simple long enough on Bitcoin, we're going to go back into a bull trend and it's risk on, let's go. Parabolic move to the upside, $100,000, $75,000, whatever our next target is, $500,000, whatever it is. We're very close to confirming one way or the other whether or not the trend is going to continue to the upside or go to the downside. Now, obviously, because of the 4-year cycles and how close we are to essentially like that December time frame, which based on our other 4-year cycles has been, the final market top, all of our cycles previously, which we only have 2. But, if you only have 2 data points, you might as well respect those data points over some mythical like imagination that we're just going to keep going on forever and there's lengthening cycles and all this stuff. Well, based on the actual mathematics of Bitcoin, based on the actual code of Bitcoin, there's not lengthening cycles. There's not. It's 4-year cycles. It's based on the halving event. So that's what I'm going to go with, is the actual information until the information changes. So what I'm saying is that over the next couple months, I do not expect us to continue to the upside. If that happens, if we get back on top of the 200 exponential and simple, if the slope continues back to the upside and price action starts to move away from them, then I will get bullish again. But until then, I'm expecting a situation like this to play out. Now, how long is that going to last for? We don't know, and we won't know until it happens. But based on previous experience, it's probably going to be about a 1-year bear market from the top to the bottom, roughly, and then about 1 year of consolidation and movement to the upside, and then the halving event hits, and then we go parabolic, and then we do it all over again. So that's what I'm paying attention to. That's how it, how that chart looks on something like the Dow Jones, and then obviously, it looks like here, oh, well, look, we were at the bottom here. Why didn't we buy at the absolute bottom right here? we start dabbling around at the 821 cross right here. We come up, we start selling into the 200 exponential and simple, assuming that we'll get rejected. And then we start moving on top. Once the 200 exponential flips to the upside, the 821 or to the upside, we start getting bullish with larger positions, start buying into strength, dollar cost averaging into strength, not buying the dip because we've been in a bearish trend this entire time. And then finally, once that cross happens, once we're back above the 200 exponential and simple, then we can start looking at, re-entering the positions, and we'll see how effective that is if we waited until the 200 simple crosses above the 200 exponential and they both have a slope to the upside, and we buy into them, and then we just stay in the market until, basically both of them flip back to the downside, which they didn't technically here. So on a weekly, you would have been in the Dow Jones from then until present, and you would be up 185%, and you would have just been long one single time for 3,548 days. So for the last 10 years, you would have just been in this position, set up, good to go. So, depending on what time frame you're looking at, that's relevant to what time period and how often you're going to be making those trades. But the fact of the matter is, this signature right here tells me one of two things is going to happen. We're either going to go into a consolidated bear market, or we're going to reclaim this price action, and then that's a beautiful place to manage risk off of. So for me right now, I'm de-risked on cryptocurrency, waiting to see how things play out. Still have open positions in the stock market, still have some open positions in crypto, but at this point in time, I have basically front run my quarterly rebalance by a couple weeks. It was bound to happen regardless. Okay, it was bound to happen regardless. We're 2 weeks away from the end of the third quarter. A lot of these, we basically pulled money out of Bitcoin after, before the big drop, put money back into Bitcoin around $30,000, rode that up quite a bit of the way, pulled a lot of those profits back out of the market, and then put them into the altcoins, which were lagging behind. Then the altcoins shot up, and we took money back out of them and put it on the sidelines. And then once again, bought the dip when Bitcoin took its big dump again, back down recently. And then once again, took some small scalp positions along the way, had some altcoin positions that ran, etc. But a lot of those positions are up now, 100, 200, 300%, depending on which ones and how parabolic they went. So at this point in time, our crypto portfolio is way out of whack. It's way out of whack. I mean, there's no reason not to be just taking some of those profits and doing the rebalancing, or at least starting it a little ahead of time. So that's my personal attitude right now. Is we're at a decision point. We're at an inflection point on the market. We might as well just lock in a bunch of those gains, sit back, and wait for the opportunity to present itself, which we're actually going to talk about two main sectors that are presenting themselves for opportunity right now as well. And I'm not talking about just some shitcoin rally. I'm talking about actual sectors and potential big movements. So, and one of them is actually contrarian, or contrary to what I actually see on the charts, but looks good overall. So we'll get to that in a little bit here. But essentially that's what I'm looking at on the Dow Jones. Obviously we're paying attention here on the monthly that we are now getting our first red histogram. We are basically maxed out on our stochastics. We're at 96, which is essentially the top of the range. And now we can see the 8 and 21 are still technically diverging, but they're starting to basically converge. We're seeing this one start to roll over a little bit. This one's going to creep up behind it. It's a little slower to lag. So we just want to pay attention to, are we going to get a situation like this? Something like a taper tantrum, or, whatever, all of a sudden inflation's through the roof, whatever the situation is, you can call it whatever you want to call it, but we typically see it in the charts way ahead of time. And then here, if we flip back to the weekly, we can see already, we basically have only bounced this weekly 21 a couple times along the way, and they're getting closer and closer together. The first time was a retest and confirmation for continuation. The second one, we got a little move here. The third one was a true test, a big sell-off here that got bought straight up, and then we gapped up, and this is a breakaway gap. We never came back to this gap on the weekly to even attempt to close it. I mean, we had a little wick down here, but we left a nice gap back here. That's totally fine. But after that, we never touched a 21 here, didn't touch it here, and then we finally touched it here, and now we see the two moving averages converging. We touch it again shortly after, and now here we touched it, and we're just hanging around, finding resistance at the 8. So we basically have over the next 2 days, we're going to determine, is this going to be basically, we have a close here and then we have an open. So the way we determine a trend is not by a close. We determine it by the close and then the open. So if we have an open and a close, like a close, then an open and closed candle in between those two moving averages, that's going to look very weak to me. And we'll see here we have here we have a close in between those two moving averages, and then we open and we shoot up above it and we don't worry about it. Here we have a close below both moving averages, and then we open and we close back above them, and then we continue to the upside. Here a close, open, back to the upside, and then here a close, open, back to the upside. So if this candle, this little itty bitty guy right here, closes below the 8 moving average, which is basically 35,000, give or take, that's going to be the first time since our dump way back here when we had that happen. And what we'll notice is that's going to tell us potentially that there's something going on and a change in trend on the weekly time frame here. Now, obviously, if we look at the weekly indicator oscillators, the TJD TDMACD has been red literally since, we had our last green histogram was May of 2021. And then we had one more green histogram, and every other one has been red. We're obviously well below the slope line. The slope line has flipped over red now. So that is very bearish for momentum based on the Traders Dynamic MACD, which if you're not using these indicators, they're all free except for the TJD Master. That one is only provided for free for people that are in the group. So, and then the other, stochastics, basically what we're looking at here is, once we leave the bullish control zone and get a hard sell signal, we're cautious, obviously, based on stochastics. But again, as long as the trend is to the upside, things look good. So even though through here, we had a sell signal, a buy signal, a sell signal, and then we finally left right here, we actually got picked back up by the 21 and then saw slight continuation back to the upside for a new higher high. Now here, but at that time, we were still above the slope line. It was still blue, even though we had red histograms. That was telling us basically we have one thing that's bullish here because we're still on top of the blue slope line, so we're still in an uptrend. Here we have one thing that's bearish, and you could argue two things that are bearish because we have a bunch of red histograms, but we're still above the 8 and 21, bouncing the 21, and we don't have an open and close below the 8. So now here we're seeing what's potentially, the way I trade, the way I determine trend, we're seeing a potential for a topping pattern taking place. So what we're looking for is, do we close now and then open and close a weekly candle underneath the 8 moving average? That's going to be our first warning sign that this is potentially about to top out and that we're close to getting a potential cross down and weakness. Still overall in a weekly uptrend. But now here we have a hard sell signal and we have left the bullish control zone. So now we have a potential bearish signal here. We have a bearish signal here. And now this is bearish as well because we have a bunch of red histograms underneath the slope line. So now this is completely bearish. The only thing that's bullish about this is we're above the 0 line, but that's essentially very bearish to me. This is very bearish to me too. We have left the bullish control zone. We have a hard sell signal. And then this is starting to show up as bearish. So as far as I'm concerned, we basically are like 66 to 75%, bearish on the Dow Jones right now on a weekly time frame. So, and then when you start coupling in things like divergence, like here we have a high on the price action. Here we have a higher high on price action. Here we have a high on our indicator oscillator. Here we have a lower high on indicator oscillator. Here we have a high on the indicator oscillator. Here we have a lower high on the indicator oscillator. It's giving us weekly bearish divergence. So, when we couple all those things in together, that's where I say I'm like 75% or so bearish on the weekly time frame for the Dow Jones. Does not mean we don't put in a new high before we sell off. Does not mean we don't just continue to the upside. So I'm not going to go in depth as much on the other indexes. I just wanted to talk about why I'm paying close attention to that right now. And here on the SPY daily, we'll notice we have closed down below the 8 and 21. And then essentially this push up today was to stop the cross from happening. So any more downside at this point in time, we're going to get the cross. And obviously we had a slight cross right here, which we averted back in May. We had a slight cross right here for a couple days back in March, and then slight cross. But this was the main cross that mattered, which was February 2020, the big dump. And then obviously, based on what we were just talking about on the daily, when did we get 100% bullish again on the S&P? Well, right about here. Once we were back above the 200 exponential and simple, and they both had a slope back to the upside, that was at $300. Since then, roughly 50% gains. You know, even in these areas right here where we saw some warning signs, we were still well above the 200 exponential and simple. And then again, we're paying attention to on the daily, 200 exponential is still above the 200 simple, but we now have the hard sell signal. We have a potential cross about to take place here. We have a bunch of red histograms in a row. We have a red slope line. So again, on the daily, this is starting to look very bad, at least short term. Does not mean we don't put in new all-time highs this cycle, or continue to, I should say. And then again, if we just switch over to the weekly, we'll notice a very similar signature here. We are still inside of the bullish control zone. So even though we have a hard sell signal, this is still overall bullish to me. We are still above the 8. So that moving average wise, still bullish to me on the weekly. But here's our warning sign. We have now crossed below the blue slope line on the TJD TDMACD. You know, you'll see here we have a bunch of red histograms, and then we have sort of some reds and some greens coming. But this is confirmation for the first sign of this flipping over to bearish on a weekly time frame. If we spend too much time below this now, the slope line will flip over red, as it did just for a moment back here while we were still above it. And then obviously that will be the second or switch this indicator to predominantly bearish. But we're still well inside the bullish control zone, still on top of our moving averages. Everything else still looking good on a weekly. We do have a little bit of divergence taking place, bearish divergence taking place. But overall, I would say the S&P looks stronger than the Dow Jones. And then here, if we just switch over to the monthly, still all green histograms. We are basically at unrealistic levels to maintain. We're up here at 98.27. So there's nowhere left to go. So at some point in time, we need to at least cool off. Does not mean this has to be bearish. We did diverge pretty far here for the first time away from our 8 moving average. If we look here, we basically have the 8 moving average directly on our ass. This is like the like racetrack dog chasing the bunny, but never quite catches it. Well, here we have diverged away from it, and it's not able to catch up to us. So at some point in time, you expect it to basically catch it. Whether it's price action slowing down and then the moving average catches up to it, or whether it's price action actually selling off like this, one way or another, price action will eventually catch up to it, even if it's just like a sideways consolidation like what happened back here. But again, on the monthly, still overall very bullish. If we see this candle start to do a bearish engulfing candle, if we start to see some of these other things flipping over like the histogram or across, even though if we're inside the bullish control zone, then we can start to get bullish on or bearish on like a monthly for at least some sort of prolonged correction. But right now, there's nothing telling me that this is like going to be some big market crash. This is like the end of everything. But it's not unrealistic to think that we could have some sideways to down price action coming up. So, and my target is still valid too. 4,600 or $460, and it's that same price target we've had for a while. So we're almost there. Do we get there? I don't know. We'll have to wait and see. Nasdaq, we obviously had the ascending triangle. We got the break of the triangle, retest for strength, came back down one more time, put in a higher low. So we have a series of higher lows, a breakout of a clear and defined area, a retest support resistance flip right here, and then a higher low after that, followed by a series of higher highs. Still very bullish on the Nasdaq overall. And obviously this could change depending on what rates do, depending on what the economy does, earnings, it can change. But it's not going to just change overnight and all of a sudden I'm like, oh, I'm bearish now because we dumped. It doesn't work like that. I still expect our measured move to play out and another 18% to the upside for a target of roughly 16,000. That's our measured move of the triangle. And then obviously that's our initial target up here. It is possible we get up higher to some of the Fibonacci extensions. We do something crazy. This would be a full-on melt up. 18,650. Is it unrealistic? I mean, it seems like it right now, right up until it, it happens. If all of a sudden we get some ridiculous spending package, if all of a sudden Fed coin comes out, if all of a sudden, the Federal Reserve or the Treasury starts just like airdropping money into people's accounts, some new program comes out to bail out the economy, anything could happen that can make us hit those targets. But everybody's going to look back and say, oh, well, the only reason we got here is because of this. The only reason this happened is because they printed so much money. But the technicals are already telling us that's a potential area that we're looking at as a top or a next target to the upside. So, show me the chart. I'll tell you the news. I'll tell you what the news is going to be. I give you 3 main scenarios that potentially get us to that target. Does it have to happen? No. But right now, probability still to the upside on the Nasdaq. And also, we need to remember, we went into a long consolidation period and we had a pretty big sell-off from when, basically these things were like the hot stuff. 12%, a lot of the individual stocks inside of this index sold off, 30%, 40%, 50%. But again, we have to be careful of bearish divergence. We do have a hard sell signal. We are looking like we're about to get the 821 cross on the daily. But again, if we just flip over to our weekly chart, weekly starting to show some signs of weakness. 821 looking to potentially cross and get a hard sell signal, but we would still be obviously well inside of the bullish control zone. Each previous time we saw this signature happen, this was obviously the CVD dump. That was a big one. We saw that coming. We were able to get on the right side of it. Worked out perfectly. But what we're paying attention to is from that hard sell signal, we actually still put in a higher high. Went up another 3%, and then we went down 30%. And then the next time we got that same hard sell signal right here, once again, from the top here, if we're going, wick to wick, obviously not realistic, but just to get a rough idea of what to expect, 12.5%, 12.6%, same hard sell signal we got back here, same thing at the top of the triangle to the sell off. That was roughly 12%. So if we do get the hard sell signal right here, what I'm expecting based on these previous two corrections is about a 12% correction, which is not unrealistic. Where is that 12% correction going to take us? Well, if we say we go from the high right now and all of a sudden we get the cross down and we sell off 12%, it's going to take us basically back to like the entry level, price target back here, which is roughly 13,500. If we sell off to 13,500, is it going to look terrible? Well, we'll have broken down from a key resistance turn support, so that will look bad. We'll obviously have a lot of weakness on our indicator oscillators, but it doesn't mean that, it's over, the market's top, To even get into a danger zone on a weekly chart like we did back here, we would have to come all the way back down to the 200 exponential and simple. When you start looking at these indexes, like Dave Portman says, these things only go up. They're designed to go up. This is a hardcore crisis if we ever are below the 200 exponential and simple. This was 2000 tech bubble burst. This was mortgage crisis burst. This was CVD. Okay? So this was nothing. This was nothing. The little pandemic, it was nothing. We literally didn't even get an open close below these. We never even flipped the slope over negative. So what's the likelihood we're going to get some crazy event like that and go into a bear market? Extremely unlikely, in my opinion. Does it mean it cannot happen? Does it mean it's not going to happen? Not at all. But very unlikely to just be starting to call out crazy bear markets and 90% collapses of the stock market and all this stuff, et cetera, et cetera. The probability has it more likely that we would just continue melting up and that one day something will break and it will not be fixable by either the government or the Federal Reserve. And then eventually we'll see, a crazy change in our lifetime. But it's probably not going to happen this decade, honestly. Maybe we'll see. We'll see. Monthly chart, still very strong. Stochs are still angled to the upside. We are still well above the 821 angled to the upside. All green histograms, still very bullish looking on the monthly chart. So, and then finally the Russell. Russell is obviously the worst of all these stocks. It has basically just been trading sideways inside the range. Once again, this is our third macro lower high. We have a high back here. We have a series of lower highs right here. And now here we have a third macro lower high. Most likely what's going to happen, we come down here, we retest the bottom of the range and the 200 exponential moving average. We see extreme weakness on the Russell as now the 200 simple is above the 200 exponential, and we have tagged it multiple times, on the daily. Not technically multiple. We almost tagged it here. But that to me is extreme weakness. If we just for reference look back, look how far away the S&P is from the 200 exponential and simple. Or I'm sorry, the Nasdaq is. Look how far away the SPY is from the 200 exponential and simple. That's back down, 10%. Dow Jones still, way down here. So just to give us an idea, the Russell is extremely, extremely weak in comparison to our other three main indexes. What's up, Peter? Good to see you, my man. Woo woo is right. Let's go. And then if we look at the Russell on the weekly, again, we have been seeing weakness in the Russell since, essentially February of 2021. We have never seen 2 green histograms in a row except for this tiny little pushback up off the bottom of the range here. We are still well above the 200 exponential and simple. The exponential is on top. We are seeing quite a bit of weakness here, and obviously on the weekly we are barely hanging on to, let's turn off our drawing tools, we're barely hanging on to the 821 at this point in time. If right now the week closed where it's at, we would be closing below the 21 moving average. We did it a couple other times and we were able to sell it, but each time we're putting in a lower high, and obviously these are converging, showing us that the strength is weakening. Typically what happens when you see a trend like this taking place is, especially a consolidation period this long, typically it will be a reversal break. It could very easily consolidate on top of here and then we just burst to the upside and the trend continues, but more likely than not, you know, looks like this is topping out on a weekly. Still a little too early to tell, but you know, potentially something like this taking place could be something like this where they look like it's going to weaken and then boom, continue new all-time highs. Now what I'm paying attention to here is though, you know, we basically have our high right here, weakness since then. If we switch now over to the monthly time frame, you know, what does this look like now? And I know a lot of people are saying, no, this isn't how markets stop out, we're going to go parabolic. Well, if you zoom out, we've been going parabolic for, you know, a year and a half at this point in time. So it's not unrealistic to think that, you know, when we look back at this, it's going to look like a realistic top. Now, this one looks more like a rounding top, but if we start getting massive selling coming in, the other indexes are going to look like a blow off top. You know, honestly, in my opinion. But, you know, there's 2 ways you top and bottom. This is a way that you top and bottom. This is like a blow off top, but obviously a bottom. Okay. Then you can also have like a rounding top, something like this, where you basically just show weakness, 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 and then kind of sell off, put in a lower high, and then bottom. And then we go back up like this. We don't need to get a blow off top that looks like this reversed. We can also get, you know, basically like a rounding top. And that's what it looks like this is doing right now. On the monthly, the Russell is very weak. Obviously, we can tell that by the other time frames, but this is our 3rd month in a row of red histograms. And again, while we still have the purple Stoch headed to the upside, the blue one is obviously headed to the downside. We're still well inside of the bullish control zone. We're still above the 8 moving average and well above the 21, and obviously well above the 200 exponential and simple. But as we can see, based on, you know, a monthly chart for any of these indexes, the 200 exponential and simple is our buying area. That's what we're looking for. And we can see why these are so important and why I use both of these. Well, if you were using one or the other, you missed a massive signal in the market, because the initial sell-off for the CVD dump tagged perfectly the 200 simple moving average, and then the second pushback down that ended up in a rally tagged perfectly the 200 exponential. So if you were only using one of these, if you were using the 200 exponential, this overshot might have scared you and you wouldn't have took a position. If you were using the 200 simple, this second pushback down here might have undershot and you wouldn't have entered a position. Somebody is using both these other than us. Enough people that it's determining price action beautifully. So in my opinion, you know, and part of why I use them in my strategy. So yeah, that's it for the old Russell. Let's keep going here. We'll look at our sectors next. XLB was looking very weak. You know, obviously materials has been looking very weak. It put in its high back in May and has been basically in a consolidation downtrend. We got our measure move breakout. It played out perfectly to the upside. You know, percentage wise, not that great, but you know, you're probably not going to get rich off the material sector. Let's be real here. Without, you know, crazy, like, I mean, I shouldn't even say that. With the options and crazy leverage, sure, this 5% move could make you rich, but you know, that's nothing compared to what most of us trade. So here we have the 821 crossing back to the downside. Obviously starts looking bearish again, as the last time that happened was the big sell-off right here. Is it possible we get a situation like this and then continue to the upside? It definitely is. This could easily turn into a bullish consolidation where we basically just sell off, consolidate, and then eventually push to the upside. But we are seeing weakness throughout on the daily here. And let's look at our weekly, just because it's been a while and I know other people are looking to rebalance, or at least I hope people are looking to rebalance. So they're paying attention to sectors as we get close to the end of the quarter here. You know, this weekly for the first time is looking, you could argue the weekly looked weak here at the bottom, like it was getting ready to roll over. But, you know, if you got bullish on this at $53, you got a pretty nice move up here to $83. If now it crosses back down and is going to potentially come back down to some of these moving averages. We're not seeing any bearish divergence taking place between these points or anything like that. So, you know, obviously nothing cluing us in that this is just going to have some massive dump or anything, but it does look weak, obviously. XLC, communication sector, you know, still very strong, still up here near its all-time highs. We did get a hard sell signal. We are seeing a bunch of red histograms. We're not seeing any bearish divergence or anything. We did close below the 21, and obviously the 8 is, you know, approaching fast. This has not had a negative cross since back in May. You know, before that, March, we had a couple along the way up here, but none of those times did we come down to the 200 exponential and simple. We had a almost retest back here in June, but, you know, based on obviously our trading strategy and the way I determine it, once we were back on top of the 200 exponential and simple, if you simply just entered into a position, you're up 65%. You have made one single trade, a buy, and no sells. So, you know, that's for people that are looking to like invest but trade and can't look at charts every day and make moves every day. They're not looking to trade a 4-hour or 15-minute or a 1-second chart. This is the strategy that, in my opinion, is most effective. And even if you make trades on smaller time frames inside of this strategy, you know, predominantly, once we cross back up here, you know we're in a bullish uptrend. So you don't want to be taking short positions. You're not, you know, you may hedge a position if we start to get like an 821 cross like this, but you're not looking to be net short on the market. So communication still very strong here. And then obviously if we look at the weekly, slight bit of weakness, but overall hard to argue that you're not still bullish on this. We are seeing the MACD, TJD, TDMACD, or Traders Dynamic MACD showing us some bearish divergence. We are now below. The histogram is below the slope line, so the slope line is potentially going to flip over red soon. So we're now seeing our first, which is more red histograms than greens, and our second, we're underneath the slope line, and it's potentially going to flip over red. So we're seeing basically our first indicator flipping over bearish on the weekly for communication. And then if we take a look at this, we basically have like a same top high right here. We do have a bearish cross. Sell by sell divergence signal, but we're still well inside the bullish control zone. We're still above the 8 moving average. So again, this still looks strong in my opinion. Communication sector strong and probably will remain strong. XLY select sector, consumer discretionary fund. You know, we have broken out of a key resistance here. We did not maintain it as support right here, which is a sign of weakness for me. And then once again, broke back above it, did not maintain. So this level to me is not that strong, but obviously worth paying attention to. But we did put in obviously a series of lows, higher low, higher low, higher low. So now if we come down to this area, I would expect price action to get picked up on this slope line here, but we really only have like 2 points, so that's not very strong to me. I would expect the ascending resistance line to be stronger, as we've seen, you know, quite a few times. We basically bumped our head on that, but essentially at this point in time, I consider this to just be a range. We're trading inside of an ascending wedge above resistance at basically all-time highs. I think consumer discretionary is still very strong. We do have a hard sell signal. We are below the slope line, seeing more red histograms, and the slope line is flipped over red. And then obviously, you know, depending on how you look at this, if we go from the open right here, since it was like a slight gap up, you know, we have technically put in some bearish divergence on some of our indicators. You know, depending on which points we look at, it's a little convoluted through here, but definitely worth paying attention to on consumer discretionary. And then if we look at the weekly, we're still well above the 821. We're still well above resistance. The weekly candle looks bullish. We're still inside the bullish control zone, but we are below the slope line here, and the slope line is red. So, you know, this is typically what you will see in a melt up. We are losing strength, but we're continuing to move to the upside. So definitely some warning signs showing up on consumer discretionary. You know, which makes sense as, you know, people start to run out of like free stimulus programs in the United States / the world. XLE, I mean, there's still plenty going on though. Shit, you want that free money? You don't want to go to your job? We gotcha. XLE energy sector. So by far the weakest sector, obviously, as it is not even close to putting in all-time highs. So that is worth note. This is very clearly the weakest sector in the market. We are maintaining above the 200 exponential and simple, but again, very weak as we have retested them multiple times. We do still have a positive slope to the upside, but we need to be very careful. Now, what I'm paying attention to that we did through here that makes me actually bullish on this sector, and I have been at least for a temporary move to the upside is, we have a very powerful push down here on the TJD, TDMACD. We have a very powerful push down here on the Jewel Thief on our stochastics. That corresponded to this low right here and a buy off the 200 exponential. The second push down here was a lower low. And then here we'll see on our indicator oscillators, we have a higher low. And then here we'll see we have a higher low. So we're looking at basically this peak and that peak and this peak and that peak. And both of those have a higher low on our indicator oscillator and a lower low on price action. That is very clearly bullish divergence. So even though we broke through the 200 exponential and simple, that tells us we're likely to get a counter trend relief rally. So if we're looking at the short-term trend is to the downside based on the 821, we're bouncing a key support and we're seeing bullish divergence play out. So we would expect a counter trend move. So the small trend that we're paying attention to is the downtrend. So we expect an uptrend. Now, does that mean we're going to take out this high right here and continue to the upside? It does not mean that at all. But we are seeing now we have crossed above the zero line. We have more green histograms than red. We have flipped the slope line from red back over to blue right here. So it's telling us the trend is actually gaining strength off of 200 exponential and simple. Although the 200 simple has crossed above the 200 exponential, we have now crossed the 821 to the upside. We are now, approaching the bullish control zone. And we'll see here the blue Stoch has basically bounced well, it's trying to, or is crossing currently back above the purple. So this was like a fake out sell-off, and it looks like we're going to see continuation. Now the knife, it's hard to see, but is all the way up here at the key levels where it typically tops out. So if we look at the previous times when we saw like a big knife strength, it was near the end of this little trend. Then we pulled back. Then again here we see the knife strengthen to the upside. We see a little continuation, then selling off. So likely at resistance right here based on these 2 points right here, seeing some kind of strength pick up on this, but probably just going to be a short-lived bullish rally to a lower high off of this point here. And if we flip over to our weekly time frame, we will see that on the weekly, obviously we are in a very, very bearish trend on the energy sector as we have been underneath the 200 exponential and simple since October, the made-up month of 2018. And then obviously you can see from the 200 exponential and simple, clearly red and purple. And going to the downside, this was just our two rallies on the weekly were just a retest of first the 200 exponential moving average, and now here the 200 simple moving average. We were in an 821 cross to the upside on the weekly. We crossed them to the downside here, and we're attempting to save that cross. Now, if we rally back up here, the more times we test the 200 exponential and simple, the more likely we are to break through. So we're on a weekly chart right now. This could push back up here, come all the way back to 56, another 10% or plus rally, 12% rally, and then come back down. And then what we're looking for is basically our low right here. We have a low here, then a high, then we have a lower low right here. So what we want to see this do is put in a higher high and then start pushing through or consolidating to potentially break. And this would be, basically a macro entrance to a potential flip in energy sector to the upside. Is that going to happen? Well, probably not. We're going to assume that the predominant trend, which is bearish, will continue. But that does not mean we don't put in a new high. The most important thing, though, is when we come back down, we put in a lower low. So we need to put in a new, a higher high based on this one right here. Or else what's going to happen, and when we look at this, we're going to see a low, then a higher high. Then we're going to see a lower low, then we're going to see a lower high, and that's telling us this trend is over, and we're going to get rejected right here and continue to the downside. So that's our two situations. We're obviously below the slope line on the weekly. The slope line is still blue, but that's a bearish indicator. We obviously have a hard sell signal, and while the blue stochastic is starting to turn to the upside, it looks like we basically just bounced the bearish control zone, like our purple line right here at the 20 level. Looks like we're basically just bouncing, attempting to try to stop the bears from gaining control. If the bears gain control, we see that's typically corresponds to a massive dump, pretty heavy dump right here. But again, we're paying attention to this overall, still bearish. And then if we switch over, we'll actually look at the monthly on this. I think that's important. while we're looking at the daily and saying, oh, we're starting to look bullish on the daily, the weekly still looks bearish, but potentially could flip over the bearish trend. But here, if we look at the monthly, we are still below the 200 exponential and simple on the monthly, and we have a red slope on the 200 exponential. And if we stay below 65 for much longer, this is going to lose the slope and flip over bearish and go into a macro bearish downtrend confirmed for technically the first time, in existence of this chart, which goes back to 2000. So we're paying close attention to it. Obviously a monthly chart, but as long as on the monthly we're still above the 8 and 21, it's going to look like we're basically just beating our head on the moving averages, trying to flip this trend back to the upside. So eventually, if we start to close above 65 bucks on the XLE, I'm going to be extremely bullish on energy. But what we're seeing here on the TJD TDMACD is we now have green histograms above the slope line, and the slope line is blue. So while here we actually flipped the slope line over blue, we never actually made it above that. So the three ways I determine trend on the TJD TDMACD for a long-term consolidated like uptrend or reversal potentially is three parts. I want to see multiple green histograms. That tells me we're starting to see some strength for the first time and a potential reversal is taking place. Then I want to see this cross above the slope line and the slope line eventually flip over blue. That's the second one. And then finally, I want to see it above the zero line. So I want to see a positive histogram versus negative. So obviously this is the zero line. So now this is confirmed on a monthly. All three parts of this indicator are bullish. Also, if we look at here, the stochastics on the monthly, obviously a hard buy signal, cross to the upside and leaving the bearish control zone. That gives us, basically our bullish signal. But the final bullish confirmation on this is we're inside of the bullish control zone. Once this red lights up back here, that's extremely bullish. Stokes are angled to the upside. We're inside of the bullish control zone. So, and then here we have the 8 and 21 cross to the upside. So we basically have two indicators that are completely bullish, our two indicators for trend on the monthly. And then we have also half of this indicator that is completely bullish. We have the 8 and 21 cross to the upside, so this is green now. Both of these are green. They have green slope. They're cross to the upside. That's great. But we're still technically we're 3/4 bullish on this because the 200 simple still has a positive slope, even though we're underneath it. But the 200 exponential we're underneath and has a negative slope. So basically, energy is actually looking bullish for pretty much the first time since January of 2020. And obviously it had a pretty heavy sell-off, but if we go back on top of this and we see this trend play out, this type of trend plays out and typically lasts for quite a while. So we can see like the previous times when we saw this same signature, we were above, in the bullish control zone, 821 angle to the upside, blue slope line, depending on where you're going from without cherry picking too much, we saw basically 150% move to the upside, and we saw this trend last for 1,400 days. So, that's quite a long time. You want to be bullish in that trade on energy. And then again, we saw a little itty bitty moon right here and then came back down. But again, we see a low, a higher low, a higher low. And then, obviously that tells us the trend is still to the upside. But here we'll see we got that same signature once again right here. Hard buy, entered the bullish control zone. We saw a decent little push to the upside, 32%. And, basically 2 years bullish on oil. So, or on energy, I should say. So, this is starting to look good on a long time frame for basically the first time. While again, we broke above the 200 exponential, we've come down and basically are finding support on it. And this is starting to look more and more like, we have a very clear defined resistance right here, which is basically where we're at now. We have a potential left shoulder here. We have a head here. We have a potential right shoulder right here. This is starting to look like basically an inverted head and shoulders off of a key support level. And then obviously that was our moving average cross right here. So I'm actually very bullish on energy, based on the daily and monthly if we get this breakout right here. So, again, that doesn't have to be confirmed, doesn't have to play out. But at this point in time, we're seeing quite a few things telling us that it might be time to, start getting pretty bullish on this. But again, we could easily come back down here and retest, and this was just part of the head. A lot of things could happen right here. Wait, did I mess that up? A lot of things could happen right here, as this could be slightly sloped head and shoulders, and it's already playing out, and we're getting ready to break out to the upside. If we got a break right here, we would expect a continuation of the inverted head and shoulders, or alternatively, what I was just drawing there, we could basically be coming up here, get a rejection at our resistance line right here, and then come back down and put in a higher low from the previous head, and then we get a breakout to the upside. I'm still overall thinking that we're going to get continuation on this, but it is starting to lose some strength. So, obviously we'll pay attention to the charts. We'll see what happens here, but energy sector is something to pay attention to. And, this is going to be a macro determining factor based on everybody that's like, no, clean energy, electronic vehicles, oil. There's and we're actually going to talk a little bit about oil and Queen Kathy. And I'm going to make fun of her for a minute, have a little fun. XLF. Financial sector, still strong up here at our highs essentially, but potentially looking like a little double tap on the daily. We did cross the 821 to the downside, came back up to it for a retest, and it looks like we're getting rejected. I still have the target to the downside of the 200 exponential and simple. We're seeing some weakness here between these points and some bearish divergence. We saw rejection on the stochastics as well as we put in a higher high. So again, we're seeing some bearish divergence. This looks like it's going to get weak. And honestly, I think there's a lot of stuff telling us that this is probably the area to pay attention to. We have a very clear, resistance that turns support basically through here. So that lines up almost perfectly with the 200 exponential and simple. We are seeing the trend weaken as the 200 simple is getting ready to cross above potentially, but I would expect that area, the 200 exponential and simple, the support, I would expect all of that to act as support when we come down to it, at least the initial test. So maybe a 10% to the downside, and then we come back up in a lower high. Maybe we see continuation to the upside, but the financial sector is, for being at all-time highs, it's looking weak based on technicals. But we're seeing on the weekly, 200 exponential is crossing back above the 200 simple. We are seeing some bearish divergence playing out between our indicator oscillators here, or bearish divergence developing, I should say. Maybe not playing out. But again, this could see continuation and invalidate it. But this, to me, is a top. That's a high right here. We have a lower high peak right here. We're below the slope line, and it is still blue. But we're seeing a bunch of red histograms coming in, and then obviously we have a high here and a higher high here. Typically, I don't pay that much attention to divergence for an overall trend change, a topping or bottoming, until I see a third drive on a significant time frame. So I want to see a daily or weekly, and I want to see either bullish or bearish divergence with 3 individual points of divergence. Typically, the second point will result in a counter trend move, and then the third one will result in, basically a big reversal. So that's what I'm paying attention to. But obviously financial looking good, still on top of the 200 exponential and simple. So any pullback we see on this, I would expect to be short-lived, and still looks very bullish on the monthly. Let's look at industrials next. XLI, obviously, we've talked about this one quite a bit. Up here at all-time highs, we are starting to basically go sideways so long that the 200 exponential and simple are catching up. We're seeing the 200 simple back above the 200 exponential. Quite a bit of weakness. We're back inside the bearish control zone. We have all red histograms. We're below the 0 line, and the slope line is red. We have the 821 cross to the downside. It looks very likely at this point in time that we will be retesting the $100 range. It's only a couple percent away. This doesn't move fast. But if we pay attention to, let's go to our longer time frame first. The weekly, it looks like we're getting ready to have the 821 cross to the downside. If this week closes below here, it's going to be tough to get back above these moving averages. And for the first time, it's going to look like basically since our cross to the upside back here at 68, it's going to look like we're going to cross back to the downside. At which point in time, I would not expect us to get all the way back down to our 200 exponential and simple. I would expect more likely than not, though, a move back down to $85, which is pretty substantial, for industrial sector. This thing's not going to move like freaking Bitcoin, but, a 16% to 18% downside is pretty big. These are real companies and actual businesses, not just Dogecoins. And then obviously we're seeing weakness. We left the bullish control zone back here. We have a hard sell signal. We have all red histograms on the weekly. We are below the slope line, and it has flipped over red. And then obviously our 821 cross would basically be confirmation that this is entering back into a weekly, at least short-term correction or bear trend. And then monthly, still pretty strong, but we're seeing some weakness here, our first red histogram. And then if we just switch over to, I'm going to go ahead and turn off the moving averages, and I'm going to turn on our drawing tools. just to kind of get an idea as to what we're paying attention to. If we really zoom out on this industrial, we have from our massive bottom back here in 2009, aka, the mortgage crisis, obviously, which makes sense. The industrial sector would take a pretty big hit during that. We have been operating inside of this blue channel the entire time. We've been in the top half of the channel, and we've been seeing quite a few times we retested the heart line in green here and found support. And then here, our CVD dump, we broke down from it and we retested the bottom of the channel for the first time. So you say, well, there's no way you could have that drawn in. Well, yeah, you can, because you have the top of the channel with a bunch of points right here, and then you have the heart line with a bunch of points right here. So that gives you an idea as to where you might be bottoming out. And we'll see that it did act as a bottom. So because this has been a bottom since 2009, for basically 12 years plus, I would expect any moves to happen in the industrial sector inside of this channel on the monthly. So if we look at that in the grand scale, we are very, very close to the top. We're very close to the top of the channel, within a couple percentage. The top of the channel is basically at the 1.618, which is $121. So potentially have another 20% move to the upside. But if we look at to the downside, what we're talking about, eventually if we come back down and touch the bottom of this channel, that's like a 32% to the downside. So more danger to the downside potentially on this. We're also seeing a little weakness here, still inside the bullish control zone. But now if we look at a shorter time frame, go to the weekly, we can see that we are operating inside of a smaller channel. And this smaller channel was from the CVD dump right here, bottom. And then we started doing the exact same thing on a smaller scale inside this yellow channel. So now here we'll see once again, we have a yellow channel to the upside with multiple touches on the top. We have a very clear heart line here that was acting as resistance and then support throughout the move up. And now here we are potentially breaking down from that support. So if we continue to hold this support, I would expect us to break to the upside and leave this small channel here and complete the 1.618 moves to the top of the channel and roughly $120. If we see a break or consolidation here for too much longer, I would expect us to come down to what's going to amount to a key area here, because it's the bottom of our yellow channel, and it's also going to correspond perfectly with the heart line of our larger blue or green heart line here. Which is going to tell me that probably if we come down to this area right here, that's going to be a buy. I'm going to want to take a buy off of $90 roughly on this, assuming that what has acted as support here, slight miss, throughout this area here will continue to act as support. And then here we see obviously resistance as well, potential support on that little gap. And then again, I would expect that to be a buying area. But does it have to work? No, of course not. We're definitely seeing some weakness taking place. But at that point in time, I would rather buy this and assume price action is going to continue inside this channel, continue to respect the heart line, and then potentially get a move from this area of like 90 back to complete our macro move, which is our potential target up here at 120. Because from 90 to 120 is a respectable move. That's basically a 33% move on the industrials, which don't happen like crazy fast typically. So there's a little deep dive on industrials. And I know I'm treating this a little bit more like a monthly close, but I'm trying to look ahead. And I was looking at a lot of these on longer time frames myself, just because of, like I was talking about, I'm basically rebalancing or already scoping out some of the different sectors that I need to rebalance to and from based on this stuff. So if something's looking really weak, but it's underweight in my portfolio, I'm not going to just pour a bunch into it if it looks like we're going to get continued weakness. But if something's really strong and it's looking like showing some weakness, I'm obviously going to start balancing away from that some. So speaking of, here we have XLK, tech sector, obviously trying to stop the 821 cross from happening. We had it happen a couple of times on the daily. We're seeing a very clear bearish divergence taking place between our previous high right here and our high right here. We have red histogram. We have hard sell signal. We left the bullish control zone. This looks like a reaction rally attempt to save this. I do expect this to sell back off. And when it does, based on this previous little like double top right here and where I anticipate the 200 exponential and simple moving averages will be by the time we get there, which, just roughly going to be like, beginning to mid-October or somewhere around there, that's going to look like some serious confluence. Our previous like tops right here that we broke out of, and then obviously 200 exponential and simple, that is a buy for me right around 143 roughly. Assuming obviously the macro doesn't just get crazy all of a sudden, etc. But, this has been obviously just floating up, melting up, whatever. Still seeing quite a bit of strength. We did save the slope line back here, but we're seeing a couple red histograms in a row on the weekly. Does look like we're about to get the sell signal on the weekly, but still well inside of the bullish control zone. So, you know, that would correspond with basically a short-term, you know, consolidation or sell-off back down to support, and then we would want to buy that support because we would expect continuation. But again, we'll have to wait and see what happens with that one. And then on the monthly, you know, this is when people say, that's not what a blow-off top looks like. We're not going parabolic. Well, what is this? This is a blow-off top. That's what people picture when they see a blow-off top. We go absolutely parabolic, straight up basically, and then we see capitulation move to the downside. Well, how does this look any different than this? You know, in my opinion, this looks like we're at like stage 9 of 10 in a blow-off top. Like, I mean, a couple large candles here, and that's a blow-off top, you know, if I've ever seen one. And we've never seen this amount of strength. And then, you know, on a monthly time frame, we're up here at 95 on the stochastics. And, you know, we've literally only ever been up to 95, this little bit right here and this little bit right here. And what do those correspond with? You know, they basically correspond with this top right here, which we saw a violent sell-off, but it immediately got bought back up. But that's 27% dump right there. And then this little sell-off right here, again, violent sell-off, didn't quite get bought up, saw a little more continuation, but we're talking about like a 24%. And then the one that happened after that is, you know, slightly less of strength on the stochastic, but that was our 33% CVD dump right there. So, you know, potentially entering the danger zone where we would expect roughly a 25% sell-off. Now, you know, assuming that just happened and we didn't go any higher and we saw that 25% sell-off come in or 20% sell-off come in, where's that going to take us to? Well, it'd be like a retest of this little peak right here from September, August, September, around like 123. So, you know, and again, to me, it's gonna be a buying opportunity unless something changes on the macro. So, but overall, tech looking good. Looking strong. XLP, consumer staples, and I'll jump over to chat here. I see you guys in the house chatting it up. We've got a few more to go, and then we'll take a little break. I'll chat with you guys, etc. XLP is looking, so basically consumer staples still roughly at our highs. Starting to see a little weakness showing up. Let's actually take off. All right, well, let's leave on the Fibonacci extension target for a minute. This is our breakout move that would roughly take us up to like 74. Also corresponds with the Fibonacci top to the bottom of the channel right here of the 1.618. Now, we top perfectly at the 1.5. This still looks overall strong, although we're starting to see some weakness. So we'll see what happens with that. Maybe the 1.5 is as high as we get. But essentially what I was looking at was the measured move of this channel break right here. And essentially all that channel is, well, we just cruise sideways inside this channel for week after week after week. You know, couple very clear supports, couple very clear resistances, and then the measure move is just the distance from the bottom of the channel to the top of the channel. It's possible we don't complete that measured move. We got, you know, halfway, slightly more than halfway there. I wouldn't be upset if it didn't play out, but I am seeing, you know, essentially some weakness and potential double top here on the daily, and it looks like we're holding that resistance turn support for now. If we break down from that area, though, I would expect at least to move to the heart line, or once again, we have quite a bit of confluence here with the 200 exponential and simple and the bottom of that channel. Now we're seeing some weakness. We're below our slope line. The slope line is still blue. We did leave the bullish control zone and get our hard sell signal. So we're definitely seeing some weakness taking place on the XLP. But we'll see what happens here. Again, we're seeing very clear bearish divergence developing. Here we have a high and we have a lower high. We're back down below the slope line and it has flipped over red. So that is looking weak now at the top of the range. So it's not unrealistic to think that this support is not going to hold and we're going to come down to our green box target area and bounce at least temporarily. Now, could we get a little lower down here and potentially overshoot the bottom of that channel, but then just find support at this little top right here? we definitely could. And I would not be surprised whatsoever to see that act as our support and just slightly overshoot that channel and get bought back up. So that's going to be a buy for me around that area. But again, we are seeing some very clear weekly bearish divergence developing. And then on the monthly, still very strong. We're up at, we're seeing only strength and momentum in our favor for now, at least on consumer staples, but starting to see some very clear weakness on the daily. So XLRE, real estate sector, obviously very strong. We're below the 8 and 21 now, potentially looking for a cross down. We basically had, from when we crossed this trend over bullish, we basically had one test of the 200 exponential and simple, and then we were able to save every cross. So if we see these flip over red and we see this 821 cross to the downside, that's going to tell us potentially, that this is the danger zone. And that we're probably going to revisit the 200 exponential and simple somewhere around like 42. And that's probably going to correspond with some serious weakness in the market. What's that going to look like? Well, maybe it's the evergreen blow up coming over to the United States. Maybe it's a bunch of extra houses coming on the market because everybody kicked out all the people that were basically squatting during the eviction moratorium. Maybe people are defaulting. Maybe they just want to sell their house because they're tired of dealing with renters and they don't trust the government now. When the government socializes private property, which is essentially what an eviction moratorium is, well, really the government didn't even do it. Technically, the CDC did it, which is a private business, which has no right to impose on people's ownership of property, without compensating them, which they did not. They created that quote unquote program, but they did not compensate people. So in my opinion, that's illegal. And the CDC and the United States government should and probably will face some sort of repercussions for that, because they basically screwed over owners. In my opinion. Now, and that's controversial. Maybe you say, well, what are they going to do? Kick all those people out on the street? We would have had a homeless epidemic, blah, blah, blah. You know what? You're looking at one side of it. I'm looking at both sides of it. No, they shouldn't have kicked all those people out on the street, but no, they should never. The government and a private institution does not have the right by the U.S. Constitution to take your property and give it to someone else and tell you you can't take it back, or that you have to let them live there, etc., whatever the situation. So I don't care what side of the argument you're on, or if you think it's fair to kick people out on the street. The fact of the matter is we have a constitution, and when private businesses and the government don't honor the Constitution, they should be, they should suffer the consequences of it. And whether that's just legal recourse, whether it's financial compensation, whatever, total bullshit in my opinion. But whatever, I might be biased because, I pay my rent, and I don't even want to get into it because I understand people are struggling, and I'm not trying to personally attack anyone. But, the government put a bunch of situations in play to basically financially compensate people so they would pay their rent, and then they just said, but you don't have to pay your rent. So a lot of people got a bunch of money, bought a bunch of stuff or invested or whatever, and then still didn't pay their rent. The government did not get the money out to people that needed that money. So in the end, in my opinion, small businesses and small landlords got really, really screwed over in this situation. So we'll see what happens, but this would be a change of trend. What leads to that, what the fundamental cause is, whatever, it doesn't matter. The fact of the matter is, we're seeing it in the charts developing here already, and a potential pullback to the 200 exponential and simple. And then obviously, the buying of mortgage-backed securities, pumping up the markets while there's no supply, because people can't kick people out and sell their house if they want to, et cetera. You can't default on people for not paying their mortgages. There's a bunch of things basically that have caused the real estate to go parabolic. I do not like this candle right here. While it's technically not a bearish engulfing candle, that is extreme weakness to me, and what you don't want to see at the top of the trend, because if we see any continuation to the downside, it's going to look like that was a top. So, but we'll see what happens. We're seeing a bunch of weakness here. We have a sell, buy, sell signal. We are still technically inside the bullish control zone, but very close to exiting it. So that's going to tell me on the weekly, based on this single candle, based on this indicator, and then a bunch of red histograms, losing strength, but still above the slope line, still blue. But that's going to tell me that we're probably very close to, basically the real estate sector topping out. And again, you have different things inside of this. It's not just people who own homes. There's, a lot of stuff inside of these these different like sector funds that will be basically, you have like a large company buys up a bunch of houses and then rents them out and then either pays like dividends or grows the company based on, the rent appreciation, etc. So, this is essentially just reflecting the entire market, not just mortgages, not just homeowners, etc. So, weekly and then monthly, starting to see probably, this monthly candle obviously doesn't look good, but overall still very bullish. Obviously at all-time highs, 95. So unsustainable trend, but again, clearly like what a parabolic uptrend looks like. So is it realistic to think we're going to go sideways or pull back here? Yes, probably. But real estate obviously was very strong throughout all this. And you would expect obviously real estate and if the government's buying 40 billion in mortgage-backed securities plus a month, you would expect real estate to do well, especially if you can't foreclose on people or kick them out. Probably going to do well. And then transportation, finally, this is the one that I'm paying the most attention to. Semiconductors, transportation, and obviously overnight repo facilities, all very important to me as they are leading indicators. We see obviously transportation sector topped out back here. I'm not sure why I'm on the weekly. Must have just left that up. Topped out back here in May of 2021. Went into a downward consolidation pattern. 200 simple crossed above the 200 exponential. We did bounce them the first time, but since then it looks like obviously weakness and we're potentially putting a lower high. We did see the slope line flip back over blue, but to me this looks like a bearish consolidation. So a bullish consolidation is where the indicators and oscillators go down while price action goes sideways. And then you have refueled for a continuation to the upside. A bearish consolidation is when price action goes sideways or floats up slightly while the indicator oscillators, float up and then price action basically goes sideways. So to me, this tells me as these start to just creep up here, but price action just goes sideways, we're probably just refueling for a continuation to the downside. This is obviously weak too because it's bouncing in 200 exponential and simple, and almost every other sector was much stronger than this. So this is telling me once again, potential weakness. Matter of fact, let's look back at the daily, and then I want to just talk about this. This was leading up to February 2020. So what were we seeing in transportation? Well, this is weakness. This is massive amount of weakness for years. So when people say, oh, COVID caused all this, everything was great, the economy was humming, we were flying, we were ripping, everything was great. Well, according to the transportation sector, from 2018 and then the top here in September of 2018, so basically January and September of 2018, and then breaking down below 200 exponential and simple, and basically, we went sideways, but overall, this was fairly bearish or consolidation period, and then we finally put in a lower high right here. This was telling us there was clearly something wrong in the economy for 2 or 3 years before suddenly, oh my gosh, CVD, oh, the Rona, oh my God, everything was great. Well, the transportation sector says no. It says, I don't think so, bro. And then obviously we saw massive, the first sign that told us something was up here is this gap. Okay, this was in February of 2020. Before there should have been any reason for people to be scared or whatever, we saw a pretty massive gap down here, on this sector, obviously. And then we saw just steady continuation. So obviously that told us something was going on here slightly before most other things did. Now, if we look at the weekly here, though, what did the weekly? Well, if we were looking at a weekly time frame, this was telling us basically that we should be bearish from May of 2015. This was basically in a bear trend from May of 2015 until March of 2016. And then we start seeing continuation back to the upside. We bounce to 200 exponential and simple. And then here we see that consolidation downtrend, barely hanging on to the 200 exponential and simple. This to me is bearish. We don't want to see less and less of a rally each time we touch the 200 exponential and simple, because eventually, if we beat our head against the door too many times, eventually we're going to break through. And that's what this is to me. So again, this was telling us very clearly ahead of time something was wrong. And then obviously the breakdown in February, was not a surprise. So now here at the top of this trend, we top out, we come back down, and we're looking at losing the weekly 821 cross back to the downside. You know, every other time that's happened in the recent history, here it happened, we came down to 200 exponential and simple. Here it happened, came down to 200 exponential and simple. 200 exponential and simple. Here, you know, we obviously massively broke through it. So if now, after that massive run up, we see something like that taking place, we're talking about a substantial move if we do what we've done every other time. We're talking about a 23% move in transportation back to retest those levels, roughly. So, you know, and again, we're seeing some bearishness, left the bullish control zone. We did get a buy signal from the neutral zone right here. But again, this looks like this is likely to fail. You know, and keep in mind, this is while, like, prices for trucking, for shipping containers, for a lot of other transportation is at all-time highs. So if there's two main factors in any you know, sector, there's supply and demand and there's prices. You know, those two things can determine direction very easily, or, you know, price very easily. If prices are at an all-time high and we're going sideways, so shipping containers are just going up, trucking costs are just going up, train freight, all kinds of, like, you know, it costs more to move products right now than it's ever cost before. Like, things are at ridiculous highs, and somehow price is lower than the all-time highs. We're seeing a divergence. So what does that mean? Well, it means there's probably less demand, but the higher prices are making it stay at that level. So if all of a sudden we see a spike down in demand, or we see prices drop because, you know, basically like the ability to provide that service catches up, we get more truck drivers, or we get more trains on the road, or we get more shipping containers, or we get more boats to move the shipping containers, or we get more planes to fly the goods, like whatever the situation is, if we see one of those things with a downward pressure when the other one already has a downward pressure, we're going to see this thing just massively sell off. So what does that say? If demand drops off, so say after like Christmas time, you know, we would expect some demand going into the holidays, etc. But, you know, assuming around like December, whatever, January, typically, like cyclically, we'll see weakness. You know, that would tell us that this is likely when we're going to get a big move down like that. And then obviously too, you know, that maybe the prices catch up by then because people lower their prices to say, you know, competitive, or demand falls off a cliff because prices are too high, or because seasonal, etc. You know, that's going to tell us this could chop sideways for a little bit. But I would say probably around January, we're going to be back down here retesting these previous couple highs, and then also the 200 exponential and simple. So again, you know, that's looking out kind of far, etc. But those are the areas we're looking for. And then that's also going to correspond with our break of the channel that we've been operating inside of. Once we broke down from that channel, that's our measure move back to that key level right there. And then obviously we have the 236, and that is our 382 Fibonacci from the bottom to the top, assuming this sector has topped out. So those are the two areas I'm looking to buy based on a lot of different confluence levels. And then if we look at on our macro weekly chart here, this is our run from, you know, basically when we capitulated in like 2011 down to a low, and then we operated inside of a channel from 2011 until we broke down in 2015. When did we see this top out? Right around, basically, you know, we hit a top around December right here. We put in a slightly higher high here in March, and then we saw basically a long drawn out you know, sell-off here. And what did that sell-off take us to? Well, from the high to the low, it was roughly about a year, roughly, and 35%. And then at that point in time, we bounced to 200 exponential and simple on the weekly, and then we did the same thing again. We operated inside of a channel, we moved back to the upside, and then here we topped out basically in January of 2018. So this is January of, you know, roughly December to March. So roughly, let's say January 2015. This is roughly January 2018, you know, December to January 2018. And then obviously at that point in time, we break down from this level and we see the initial move from the high to the low down here off of the 200 exponential and simple, 26% sell off. And then we can't get back above that high right here. And then we actually see this dump take place roughly this high right here in January of 2020. And now here we are potentially doing the same thing again, breaking down from a channel, going sideways. So here we went sideways for a little while, retested the bottom of the channel, but could not put in a new all-time high. Here we basically top out, but still inside the channel, put in a new high, and then break down from it. So what is the likelihood that, you know, basically this was our top in like May, and then we continue kind of floating sideways, possibly even push up here around December, put in a new all-time high, and then January start to see that dump down? Seems very likely to me, based on like the cyclical nature of this, that like January 2022 or something like that, that we would be potentially in the process of a big dump. So that to me it's notable enough, worth paying attention to, that each time we broke down from one of these channels, each time we roughly topped out cyclically around like a January type time frame, and each time we retested the 200 exponential and simple, or blew through it, obviously, in this situation when everything came to a stop. So I'm expecting a move like that somewhere around the end of the year, which would correspond with basically my idea that we're probably going to see some sort of like macro, at least temporary top on these markets around that time. So, and then jets, obviously. Let's just look at these ones a little quicker. We'll see because this stream is going to go so long. I'm an hour and 30 on just traditional assets right now. Just on this. But again, we're coming up on basically, you know, the end of the week, you know, halfway through the month only, but potentially the end of a quarter. So if anyone's looking to rebalance or potentially looking at more of like the macro view of things, I think this is a very important time to be paying attention. So here we have obviously our massive capitulation dump, and now here we are back below the 200 exponential and simple, and they've rolled over to the downside. This looks very bearish to me. I expect continuation, even though we're seeing a little bit of strength. That's good enough. Hale basically just hanging on to the 200 exponential, 200 simple above it, seeing some definite weakness. You know, this got a little more like rental cars in it, etc. Weak for sure, as opposed to jets is more like planes and transport. UPS, obviously very weak, and it looks like we're going to leave behind this gap, at least for now. I'm still potentially expecting a bounce off the 200 exponential, and then, you know, this would correspond again with basically a rally off of the 200 exponential and simple, off of the support area down here, and then basically like a price rally coming into like the end of the year, holiday, Thanksgiving, Christmas, all the extra shipping that's going to take place. Now, is that extra demand? Is it them just raising prices? Is it a combination of the two that lets us come back up here and fill the gap? Either way, it's probably going to be somewhere around a 10 to 15%, you know, clockwork move. So definitely paying attention to that on UPS. And then FedEx did not leave as big of a gap, but, you know, another gap here left behind. And then this one is showing extreme weakness. It broke down powerfully below the 200 exponential and simple. They have both rolled over, and this is like basically a macro megaphone, you know, going back to essentially a top from 2014. I don't want to see this thing come all the way down to the bottom or even the heart line, but if it does, we're talking about a potential, you know, top. If we put in a new high, we're talking about a move back to like 327. If we just retouch the heart line, we're talking about 179. If we come down here to the lows, we're talking about $100. That is probably a very, very bad situation. I'm not sure why FedEx's chart is so terrible, but apparently people don't like it. Okay, so let's look at